Hello and welcome to episode 383 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leakes. Damien, busy podcast this week, lots of news going on, and actually we're going to feature a lot of what's come out in the news this week with the latest news on the energy price cap freeze, which moves us on nicely for what we talked about last week, but obviously a big day for news.
Yeah, so this week there's been a lot of news. We had a new Prime Minister. Unfortunately, we do offer our condolences to the royal family on the passing of Her Majesty Queen Elizabeth II. It would be wrong of us not to mention it, but of course we are going to be moving on talking about the money stuff anyway, because there's big news surrounding energy prices, and as ever, we will continue delivering our podcast as planned.
And so let's move on to what's coming up on the podcast this week.
Yeah, because it is a packed show. So we talked about energy prices and whether it was worth fixing your energy last week. Well, there has now been government intervention on energy pricing. So we're going to be talking about what was announced, what it means for you, because it is good news for consumers, but it doesn't change the fact that energy bills are going to still be going up. I'm going to be doing an interesting investment piece actually on a different way of deciding an asset allocation on your portfolio and rebalancing. So something slightly different that can enable people who perhaps are trying to notionally protect an element of their capital, how they might be able to try and increase their returns and have a dynamic asset allocation. It may be, for example, you're nearing retirement. And the final piece I want to talk about is something called the principal agent problem. Now, this is something that will impact everybody. It occurs throughout life, not just in finance, but it means there are conflicts of interest that can actually be detrimental to your wealth. So I want to explain to people how you identify that and how you deal with it.
Okay, so let's move on to the first piece then. And it's an investing piece about how to rebalance your portfolio and an interesting take on doing that dynamically.
So I wanted to do something a bit different I've not spoken about before on the podcast in relation to asset allocation and rebalancing. Now, if you go back to podcast 183, I talked about rebalancing, and in episode 290, I revisited the idea of rebalancing and gave you some tips on how to do it in different ways. So across those episodes, I talked about the frequency at which you should rebalance your portfolio. And by rebalancing, I mean where your asset mix might change over time because you might have an equity rally. So your equity component of your portfolio does very well and becomes a larger part of your portfolio, meaning you're taking more risk, while the low end of your portfolio, the low risk end, might maybe have lagged behind. So that could be bonds or something like that, or it could be another portion of your equity part of your portfolio may have underperformed. Let's just say it could have been, for example, European equities might have lagged US equities. You then decide you want to bring the risk back in line, rebalance back towards your target asset allocation that you decided at the outset when you began investing. And listen to those podcasts. I go into detail about different ways you can do that. So you could decide to rebalance by doing it based on frequency. So you do it maybe every quarter, every 6 months, every year, and you readjust your portfolio, selling some areas, buying others in order to rebalance so your asset mix is back to where it started. You could instead do something where you allow your portfolio to drift, so you have a tolerance level. So let's say you had 10% invested in US equities, then if that allocation got to say 13%, then you might decide that's the point at which you then decide to rebalance and move it back down to 10% by selling some of your US equities and maybe investing into an area of your portfolio where the allocation had fallen because that asset had underperformed. And of course, you can get a combination of the two, and you can, of course, buy off-the-shelf funds or portfolios that do this for you. But for DIY investors who like to take control and make their own decisions when it comes to investing, they will have to make a decision how they allocate their money, which assets they buy, and how frequently and how they rebalance. But as I say, go back and listen to those episodes so you are up to speed with all the different ways you can do that. But what I wanted to talk about today lends itself to some questions that I've been asked in the past. So, for example, I've had people who ask me, is there a way or some kind of indicator which they could use that could allow them to open their shoulders a bit. So you imagine like in cricket when a batsman's in the flow and they start knocking sixes out the ground, a point where they can then start to take on more risk because they want to be a bit flexible. But if the market has fallen, for example, and they become a bit risk averse, and they might start being a bit more forward defensive, so they might want to take less risk rather than keeping the risk level of their portfolio, the risk that they're taking, static. Could they flex it? And so that's based upon what's going on in the market. And it's an interesting question because, of course, people's risk tolerance can change and it is a personal decision. Now, of course, we've talked about the age guide in the past. So for someone who may be 40, they may decide to use the age guide to decide how much equities they should invest in. So how much of the higher risk stuff they should have in their portfolio. And the way you would do that, you take your age away from the number 100. So you take 40 away from 100. That would leave you 60. And therefore you would put 60% of your investments, your money, into equities, for example. And you could decide how you split that mix between things like UK equities, North American equities. But as a class, you might put 60% in equities and then you put the other 40% in lower risk assets like bonds. And so for a medium risk person, that is a pretty useful guide, and it is used as a bit of a finger in the air and a benchmark within the asset management industry. But as I said, it's really for somebody who's medium risk. What about if you're more risk averse? So in that instance, you would want to reduce that number, almost make out you're a bit younger. So therefore, you'd have a higher allocation to something like bonds and a lower allocation to equities. Equally, if you want to take on more risk, then you'd have to increase your equity component. But how can you do that? Because you've obviously got to pick a number out of the air. And so that is an interesting question of, is there another way in which you could decide upon your allocation? Also, I know there'll be people out there who may decide that they have a lump sum of money, let's say it's £100,000, and fundamentally they would quite like to make sure they get £80,000 back or as close as they can do. So while they can't guarantee that amount of money, they don't really want their portfolio to fall below £80,000. So that means that 20% fall that they can stomach is the limit, at which point they might be out of the market and decide they don't want to do it anymore. They pull their money out, which obviously over the long term, if you're going to invest, you've got to understand the risk that you're taking. But I'm just talking about the idiosyncrasies of money. I know how different people's minds work. And so there is another way to look at money and asset allocation, which I'm going to come on to, which is called constant proportion portfolio insurance. So CPPI for short. Now, it can sound a bit complicated when I start to explain, but fundamentally it's based on a bit of simple mathematics, which I'm going to help you understand. So let's go back to the example of £100,000. If somebody had £100,000 and they didn't really want their portfolio size to fall below £80,000 for whatever reason, maybe they're reaching retirement. So they're getting to the point where they don't want their portfolio to fall from 100,000 to 80,000. But of course, they want their cake and eat it. They want to be able to get increased investment returns on their money. So they want to take some investment risk. Of course, one thing they could do is just be £80,000 in cash. So that's 80% in cash, and then only invest the other 20%. But of course, they're only going to have investment-like returns on 20% of their money. So that limits what their overall return is on their £100,000 when they look at it in its entirety. But there is another way in which you could look at asset allocation, and it's this CPPI. So it's basically a way of dynamically changing your asset mix based on what's going on in the market. And what it does, it essentially, as markets might start to rally, so you might have the high risk portion of your portfolio do well, then you start to increase your allocation to that particular asset class. And equally, if the high risk element starts to tumble, then you start to go back into your shell a bit and you start to reduce your allocation to try and protect that notional £80,000 that you really would like to protect. So in that example, let's say you had that £100,000 and you might think, well, I could invest £20,000 in equities. It could be individual equities, it could be some index, it could be a mixture of all of that, it could be funds. But you've looked at, say, the S&P 500 and you've noticed that, look, over the long term, there has only been 5 occasions in history, despite some of the massive sell-offs we've seen, where the sell-off from top to bottom has been more than 33%. So You might think, why has Damien picked 33%? You'll come to understand in a minute. It makes the maths easier to understand. But 33%, there's only been 5 occasions, and one of them was the dot-com bubble bursting, and the other one was the Great Depression back in the late 1920s. So you might be sitting there thinking, well, I'm quite comfortable with that fact that, yeah, do you know what? Markets do fall, but if they fell 30%, then if I still had the £80,000 left after that, then at the point that I review my portfolio, I can decide whether I want to quit or stay in the market. Like I said, putting aside the idea that you should be invested for the long term, this is just a different strategy that is employed within the financial sector and investment management space. So I'm just telling you how it works because you may like it and want to explore it yourself. So you decide, you know what? Let's say the market did fall 33%. That would mean that if you had an equity component of your portfolio and a safe component of your portfolio, which could be cash, but maybe we'll say it's going to be bonds, then if that equity component fell 33.3%, so you lost a third of it, then if that equated to 20% of your overall portfolio, then you would say, well, yeah, between my 2 review dates, if I lost 33% on my high risk element, my equity component, but that equaled the 20% buffer that I've got between, that's the difference between the £80,000 and my overall £100,000, then I probably would swallow that and I'd be okay with it. Because I understand that in order to get the returns that I want, then I'm going to have to take a bit more risk. You do the maths in your head, £20,000 is exactly a third of £60,000. So what that means is that if you invested £60,000, so 60% of your portfolio in high risk investment. So I say high risk, let's just call it equity so you can have medium to high risk. And you had 40% in the low risk, cash, maybe even bonds, then if the high risk component of your portfolio fell 33%, creating a massive market crash, I mean, that was only the equivalent of what it fell, the S&P 500 during the COVID sell-off. So that shows you even in extremes, 33% is a lot. Then you would still have more than £80,000 in your pocket when you come to do your review. And at that point, you could then decide what you were going to do. And maybe you were deciding, do you know what? I'm not going to take any more investment risk. Actually, £80,000 is what I really don't want to go below. So for now, I'm going to reduce my risk until some point in the future, which is what this method of dynamic investing will do. So in that example, I said if markets fell by 33%. So basically, you lost a third of that high risk part of your portfolio. Now, what you need to do is that you flip that number on its head and it becomes 3. So rather than a third, it's the number 3. That's called your multiplier. So in my example, I worked out that if you multiply 20,000 by 3, that gives you 60,000. So if I lose a third of that 60,000, I've only lost 20,000, which was my buffer, the difference between my 80,000 that I really didn't want to lose and the £100,000 in my portfolio that I started with. So let's say, for example, you decided that looking at equities, you thought, well, 20% is broadly what I think markets are going to probably fall. That's what I'm happy to basically bet upon. Then the multiplier becomes 5. So that means if you think about it, that if you've got a £80,000 amount you want to try and protect, you've got a £100,000 portfolio, you've got that £20,000 buffer, 5 times 20,000 gives you 100,000. Well, lo and behold, that would mean you put all your money in equities because you're thinking that, well, a 20% fall, that will take you back to your 80,000. So that's what you're trying to protect. Now, if you started off at the beginning with my 33.3% example, so you were saying that markets, yeah, they could fall 33%. Let's pretend that's the worst case scenario between each of my reviews, whenever that is. That could be a 3-monthly review, a 6-monthly review, a yearly review. You think that's the worst case scenario that's going to happen. And you decide that yourself because that's obviously your risk tolerance. Now, in my example, I said that would lead you to having £60,000 of your money invested in equities of some kind and say 40% in cash. Maybe we'll say bonds as well. I'll come on to that later on about the issue of using bonds. So that sounds very much like a 60-40 portfolio, 60% equities, 40% maybe bonds. And yep, you could say let that be a Vanguard Life Strategy Fund with the 60% equity exposure. This is just an example. Now, what would happen then using this same methodology when the portfolio increased in size? So let's say your low risk part of your portfolio didn't grow. They just sat there not really growing, but your equity component had grown from what you started out with at £60,000 and it had in fact grown to £70,000. Now, that would mean your overall portfolio would be worth £110,000 now because the equity component's gone up £10,000. So you've gone from 100,000 to 110. Now, your buffer between that 80,000 you really don't want to lose is £30,000. You've got a nice £30,000 cushion. Now, of course, you've said in your head that, yep, looking at the numbers, I think a 33% fall between my reviews is, I think that's realistic. And so that kind of worst case scenario, it's up to you, because don't forget, equities can fall by 100% even, theoretically. So you decide to apply your multiple of 3, as I explained, to that difference you've got between 110 and your buffer. That now means that you've got 110 minus 80, that gives you £30,000 as your buffer. You times that by your 3, your multiple, so basically that leaves you with £90,000. That is what you invest now in your equity component. When you work that as a percentage of your overall portfolio, which is now £110,000, lo and behold, that equates to 80% in equities. And that means that the £20,000 you've now got in low risk stuff, because don't forget, you have £90,000 now out of your 110 in equities, that leaves you £20,000 left to put in the low risk stuff. So that equates to about 18% in low risk stuff. Lo and behold, your portfolio has shifted from a 60% equity portfolio to an 80% equity portfolio, because the high risk stuff is flying. So you're doing that thing I said the cricketers are now starting trying to hit sixes. It does ramp up your risk that you're going to take, but because the buffer between your portfolio total size and the £80,000 that you really are worried about has increased, it means you can take a bit more risk. And if I was going to use a Vanguard idea, it means you've gone from the Vanguard Life Strategy 60% fund to the Vanguard Life Strategy 80% fund. So you can see that this concept answers that question that somebody says, well, how could I decide when to move and flex and increase my investment risk and change portfolios? This concept does enable that. But of course, there are flaws, because what you're really doing is the market's really flying. You are starting to buy at a higher rate. Now, of course, fundamentally in the long run, buying high and selling low is not a great strategy. But what this is doing is allowing you to ride a bit of momentum. But of course, then what will happen? Let's take the opposite side. So let's say markets fell. So you started with your £100,000, like I said before. You worked out what you thought your worst case scenario would be, that you think markets aren't going to fall more than 33% between your portfolio reviews. Again, that's a bit of a finger in the air, but it's something when you've looked at history you're comfortable with. It's the risk you're going to take. That left you with a 60% equity, so £60,000 in equities, £40,000 in low risk assets, cash, let's say even bonds. If the market had fallen, so the high risk stuff had tumbled, and it meant that the £60,000 that you had in the high risk stuff had in fact fallen to £45,000, so a significant fall, that would leave you with £85,000 in total, because you've still got the £40,000 in the low risk stuff. Now you've got 45 in the high risk stuff that's taken a battering, leaving you with £85,000. Now, you've only got a £5,000 buffer between what your portfolio is now and that £80,000 you were trying to protect. Now, using that multiplier that, again, I've explained how you work it out. In this instance, it's 3. So basically, you then would invest 3 times 5, which is £15,000 in equities. And the rest of the portfolio, which would be £70,000, 70, would be in the low risk stuff. So you've increased your low risk holdings from 40% right the way up to £70,000, because you're getting to the point where you're going to breach the £80,000 level that you wanted to protect. You've got only £15,000 in equities, because don't forget, a third of £15,000 is, you've got it, £5,000. So that's how the numbers are worked out. So if you work that out in terms of percentages, it means that only 17.6% of your portfolio is now in equities, while just over 80% is now in the low risk stuff and bonds. So you've just drawn right back in to your shell like a tortoise, because the market has beaten you up a bit. But it means that you're protecting your capital, but it means you are also less likely to benefit from the upside in the long run, of course, because it works like an insurance policy in effect, and that's why it's got the name insurance in the title of the type of strategy. Now, those numbers, what will have happened there is that you've effectively then moved into like the Vanguard 20% equity fund. So now doing forward defensives, and your money isn't going to grow that much. And the flaw, of course, to all of this is that the low risk stuff doesn't behave how you hope it will. So let's say you're not in cash and you've gone in bonds. A year like this year, where bonds have tumbled alongside equities, as unusual as that is possible. So you could have lost even more of your money. So it's not fail safe in any way. If you really want to keep the £80,000, then you need to be in cash. But for some people, this is a slightly different way of looking at it. They've got a notional amount of money that they would like to try and protect in some way. There's no guarantee, but by using a system like this, they're able to flex. And as their portfolio gets way above that £80,000 number in my example, they take on more risk because they can afford to effectively lose some of that profit. But as they creep down towards that 80,000, they start to take less risk. And of course, this will keep flexing over time and over time. Obviously, think about it logically. Let's say your portfolio does very, very well. Then eventually what's going to happen if your £80,000 that you wanted to try and protect will become an increasingly smaller part of your overall portfolio, effectively meaning at some point you will just end up 100% invested in equities. Now, that is going to make you not just taking on risk, you're taking on the house effectively, aren't you? You're trying to put everything on black or whatever. That is something you're going to have to look at each of your reviews, because that's one of the downsides of this kind of strategy. One thing you can do instead is you can start to increase that notional £80,000 in my example. So each year it would go up in line with the increase in your overall portfolio size. So if you went from £100,000 to £110,000 in terms of overall portfolio size, which is a 10% increase, maybe you could use a similar percentage and apply something like that to the £80,000. So your notionally protected value is actually increasing at the same time. Like I said, there's no guarantee to this, because what you're actually doing is taking on more investment risk to try and boost your returns rather than just having it all sit safely. If safety is the priority, then you should put the money in something that's safe, i.e. cash. Now, of course, given that it acts like an insurance policy, you're not going to capture all the upside using an asset allocation strategy or rebalancing strategy like this. When they've done the numbers and they applied it to the S&P 500, for example, and they tested it going back to 2015 to date, so that's across the period like the pandemic, then what happened is you got an annualized return of just over 6% versus just investing in the S&P 500 where you'd got about 10.46%. So using this method knocked off 4% of your returns annualized. So that's basically each year, which obviously makes a difference compounding. And that was with using a multiplier of 3. So that was like using the same example where you thought the market worst case scenario would fall 33.33%. And as long as it didn't fall below that before your reviews, you were still going to be able to draw out your £80,000 and run in my example. So yes, using the CPPI method, you only got a return of 6.13% annualized. But for some people, that might be attractive. So if you found that interesting, it's something slightly different. It's a way of trying to flex and then play forward defensive. And it is used in trading because obviously it can work quite well with people having very short review periods where they might rebalance. They might hold particular equities, maybe a small number of equities, and they may use this strategy to try and limit their downside, but obviously give up some of their upside. There are a number of investment products, so structured products and things like that use this kind of idea, and it's all built into that notion in a complicated and expensive way. But the strategy itself is quite simple. And so I wanted to tell you on the podcast so you could go and explore it, look at it and say, actually, that is an interesting concept which has definite pros and cons. And of course, one of the big cons is that diversifier asset. So the low risk stuff, if it's bonds, whatever you choose, then it might not provide the protection that in these examples where it's effectively not falling in value, which isn't reality, then unless it's cash that you're using as that asset, then you have got to bear in mind that you may have both parts of the portfolio fall.
Okay, well, I found that fascinating. It's certainly something I hadn't heard of before. And I think potentially this is something that might be good for those kind of investors who are ready to take more risk but don't really know how to. This gives them a potential strategy to explore. But also conversely, people who want to dial back that risk, perhaps they may want to protect their assets, like someone who's potentially approaching retirement. It could work for them too. So really interesting. Right. So let's move on to the next piece then. What have we got?
So a quick piece I wanted to do on the podcast is something called the principal agent problem. And the reason this is interesting because you can see it all around the world in lots of different examples, but it's quite prevalent in the world of finance. And it is something that is detrimental to your wealth. So the principal agent problem, I'm going to read a definition, which sounds a bit clunky, but I'm going to then explain in more accessible terms what it is with an example or two. So the principal agent problem arises when one party, the agent, agrees to work in favour of another party, which is the principal, in return for some incentives. Now, that agreement may incur quite large costs for the agent, which leads to this whole problem of moral hazards and conflicts of interest. And there's normally an asymmetry of information that's there as well. So that means that one of them is privy to more information than the other, and it can end up leading to the agent pursuing their own agenda, which isn't in the best interest of the principal. So first things first, what do I mean by principal and agent? So let me give you an example. The shareholders in a company would be considered the principals in this particular example we're going to give, whilst the agents are the management of that company. Now, the shareholders own the company, whereas the agents effectively work for it. Now, the agents will be remunerated in certain ways and will have targets that they're due to hit that will be beneficial for them personally. So you may get to a scenario, for example, where they may try to retain profits, or they may make decisions internally that increase the chances of them achieving the targets that they're being assessed on, which may in turn increase their own remuneration and salary, for example. But that would fundamentally be at the detriment, you could argue, to the shareholders, because the profits of the company could be reduced and therefore the dividends paid out to the shareholders will be less. So that's a good example where you can get the principals, which are the owners, don't have all the information that the agents do, who work there day in, day out, and they know everything about the company and the market and what's going on behind the scenes, and can make decisions that can be in their own favour. Another example that's not in finance is the world of politics. So as voters, we are the principals, because obviously there's a long-term benefit and a long-term interest we have in this country. We are it. Whereas the Prime Minister is the agent. They're an elected person, a bit like the people who work for the company. They're chosen, they're put in place supposedly to carry out our best interests and work in our best interests. But their own interest is their own political gain, their own job security. You've seen it play out time and time again. All prime ministers have a very short-term view, just trying to be re-elected. So it stops solutions being implemented for the longer term. It's very short-termism, all the solutions they have, because they just want to be elected and then they'll be gone. It'll be somebody else's problem. Therefore, you get a conflict of interest. And of course, I'm not going to get into politics. You can see for yourselves, and you know of the conflicts of interest we see between our political leaders and parties and the greater good of us as people. Now, you can also get it in areas like, for example, financial advice or investment management. So you could have, for example, a wealthy individual who goes to a financial advisor, could be a mortgage broker, and they go for advice. But there is an asymmetry of information. They don't have the same information. The agent, so it could be the mortgage broker, it could be a financial advisor, has a lot more information about the market, for example, about what's going on with mortgage rates, the products out there, how much they get paid, ones that will pay them the less. And they therefore have their own interests at heart, which are very short term. You might be a client who's only going to take out a mortgage product. You won't be around in the future, yet they've got bills at home that they might need to pay. Yes, these people are meant to work in your interest, but the setup means that conflicts can and do arise, because you as the principal are focused on the long term. You're focused on the ownership of a property. It's your money, but it's not aligned, for example, with the person who might be on the other side making decisions. You might not know that a new product is about to come out that you could wait for. They might not tell you because they're only going to advise you on the ones that are available at the moment. And that one might be better for you, but it might pay them less. So there's lots of asymmetry that exists out there and lots of these examples. You could even give a really simple example. Let's say you're at work and someone said, I'm popping next door to go to the shop. Does anybody want anything? And you say, oh yeah, I actually wouldn't mind some lunch. You're the principal. It's your money. You've given them. They're the agent and they've gone to the shop. But what they didn't tell you, because they need to go and get something for their dinner tonight, they've gone to a particular shop that is more expensive, that's got a decent meal deal for the evenings, but they actually have more expensive sandwiches. Therefore, they're not actually in your best interest to get you the best food or the cheapest. They are buying you a sandwich, but they haven't told you all the information, because perhaps if you'd known that they were going to go to M&S and get a sandwich rather than go to Tesco, you might not have given them your card to go and buy lunch. So that's an asymmetry, and you get a conflict of interest going on there. It happens everywhere in life, but particularly in money. So when you have money or any wealth, you can see how there are conflicts of interest based upon how people are paid, based upon their own agenda, which conflicts with your own interests. So how do you overcome this principal agent problem? Well, sometimes you can't, because it might need a whole change in the way an industry is run, for example, or the way things are done. The key is to get the right incentives so they are aligned with you. So the agent's incentive, the way they're paid, the way they are rewarded in any way is in line with you. And the more you can do that, the more likely they're going to make decisions that are going to always be in your best interest, and there aren't going to be those conflicts. Sometimes it can't be done that well, but you have to manage them. So one way would be full transparency and education. So you need to find out as much information about something, ask questions, because therefore there is no asymmetry going on in terms of information. You know as much as they do, and therefore they are going to be more likely aligned with you because they'll have to be making decisions that are definitely in your interest. And you could change the way people are paid or the ownership of things. Now, Vanguard is a very good example of this because Vanguard, you may not realise, is actually owned by its funds, which means that the investors in the funds actually own Vanguard. And that means that Vanguard can therefore drive down the costs because it's in everybody's interest. And that concept is why Vanguard has done so well and it's able to operate in the way it is. It's a different model that works well, but it solves this problem because it isn't this conflict of interest where you're just trying to drive up the fees you charge on everybody to make a greater and greater profit. So the message is just look for the principal agent problems, especially if you're the principal, because you want to make sure that people are working in your best interest. Try and spot as many as you can in life. If you are the agent, which will happen, then the key is to try and think like the person who is the principal. It could be an employee. You could try and think like the owner of the business. And if you do, you'll probably find you'll be much more successful because your interests are aligned. And it is one of the reasons why you end up getting these incentives where people end up becoming part owners in the business over a period of time because their interests are in the growth of the business. And there's a definite movement towards more structures like that.
Okay, another interesting piece, Damien. I'd never really thought of it like that. And I must admit, next time I offer to get lunch, I'll start to think about what I'm actually saying and maybe check with you which shop you'd prefer me to shop at so that I don't fleece you for more lunch than you want to.
The practical use of the principal agent problem and resolving it. Good, Andy. I like it. Okay, so moving on to the final piece that Andy is going to take the reins for. So this is in relation to the energy price freeze announced by Liz Truss this week. So it's all very new. We've got some details and there are things that are still going to be ironed out in the coming days and weeks, no doubt. But Andy's going to give you a lowdown and then I'm going to finish it off by explaining how it impacts you in terms of pounds and pence.
That's right. So last week we covered it in depth in the podcast about what these new energy price caps mean and the predicted price caps going into the future. Well, the first thing to mention is no matter what the government has announced, those price caps still exist. Ofgem sets those price caps. They meet every quarter. They announce what those caps will be. And you need to remember that those do still exist, which means that energy prices will still be going up. And it's worth going over those numbers so we get straight exactly what we're talking about here. So we're in a position right now where the energy price cap set by Ofgem is £1,971. Now that's the headline figure that we hear in the news. What that means is for the average household, that is the amount that you'll pay per year for your energy usage. It was announced recently that that amount was to go up 80% to £3,549, and that spooked everyone. It spooked the government, us as consumers, businesses as well, and it left a lot of people hoping for some kind of government intervention. And it obviously inspired our podcast last week where we actually looked at those numbers and the projections from companies like Cornwall Insight that said that those bills were going to rocket to potentially over £5,000 per year on average, which we worked out could actually equate to over £450 per month for energy.
So what the government has now done is announce a price freeze whereby they will subsidise what consumers pay. So beyond a certain level, price per kilowatt hour of the electricity and gas prices, they will pick up the tab. So as Andy says, the caps set by Ofgem are still there and they are still due to increase. But the government has said, don't worry, we're going to pay the balance above a certain level. Put it this way, it's a bit like if you went to fill up at the petrol station and the price was £1.90 a litre and the government has said to you, don't worry, we're going to pay anything above £1.60 a litre. So therefore, you know that's the maximum you're going to end up paying, but the price of the petrol is still £1.60, £1.70, even £1.90. They're picking up the tab, and it means that the bill that the government could potentially have to pick up for consumers is very high. But it means, as consumers, you can then budget about what you're likely to pay for your tank of petrol. So that's effectively what's happening in the energy market.
Okay, so looking at the numbers then, the price cap set by Ofgem is currently £1,971. And on the 1st of October, it's due to go up to £3,549. The government has introduced the new price freeze, which is going to freeze it at £2,500 for 2 years. But what we've got to remember is that Rishi Sunak had previously agreed a £400 discount on our energy bills this winter, bringing down that £2,500 effectively to £2,100 for the next year. Now that is only just a little bit more than the £1,971 currently set by Ofgem, and that will be a relief to consumers.
Yes, and just to reiterate your point there, that £2,100 is the effective annual amount a typical household will use and spend this winter. That will be £2,500 next year, because obviously that £400 discount from Rishi will no longer be available. Energy prices could keep rising in the background, but because the government is subsidising them at that £2,500 rate, then that will protect people, which is obviously good news. So what does that really mean in terms of your monthly bills? Because most people pay monthly. Now, under the current price cap before October, you'd have been looking at about £165 a month in terms of payments for your energy if you were using basically real-time payments rather than smoothing out over the year like we do with direct debits. And that was obviously going to jump much higher towards well over £300. While with the new price freeze from the government, effectively you're going to be looking at a monthly bill of around £175-ish on average. But again, it depends on your usage. So people who use lots of energy or maybe live in badly insulated homes will pay more because their usage will be higher. Those who use less will pay less. So there's good news that we now know that our bills are going to be capped at the amount we're charged per kilowatt hour of energy that we use. But it does mean that our bills can go up depending on our usage. So we still got to be careful, and we're still at price levels that are historic highs. So that isn't good news on one regard. So the other thing to point out is that obviously there'll be people who may have started fixing energy prices. If you've done that in the last 14 days, you can, of course, cancel that. You have a 14-day calling off period with any financial product. So energy is included in that. So if you've just fixed your bill in the last 2 weeks, then you could actually call up your energy provider and cancel that without any charge. And you could therefore go back on to their standard tariff and benefit from this cap. So what about those people who have already moved on to fixed rate tariffs before the last 2 weeks? So they may have done it earlier in the year. What's going to happen to their bills? Now, in the last 24 hours, it's been moving quite a bit. Initially, they were suggesting that people would be able to move on to their standard tariffs with their energy provider without paying fixed penalties. That then started to change and started to sound like it was going to be a provider by provider decision. But now, just as we've gone on air to record this podcast, the BBC is reporting that people on fixed rate tariffs will also get the discount automatically. So everybody should be hearing from their energy providers in the next couple of weeks about this new price freeze.
A couple of other brief mentions. Again, the details are a little woolly, but for people who live off grid and perhaps use heating oil in their homes, maybe they've got communal heating systems, and people who live on mobile home parks, there will be a fund that's being created for those people. However, the Prime Minister didn't really give any details on that. We don't know how big that fund will be or how long that fund will last. So watch this space really for that. And for businesses, again, not much information, but it has been announced that help will be provided. What we're hearing at the moment is there'll be help for up to 6 months with further support for vulnerable industries further down the line. Again, we're likely to hear more in the coming days.
Okay, so that wraps up our piece on energy. We've packed a lot into the podcast this week. So I just want to say before we finish, if you do appreciate all the efforts that we put into making the podcast, please do leave us a review. There was a great review I saw on Apple Podcasts that I was going to read out, but we'll leave that till perhaps next week, pending a wave of new reviews from you listeners. So get them in and we'll go through them in a future episode as they are incredibly motivating for the team. Usual admin, don't forget to join our Facebook group, facebook.com/groups/money to the masses. And of course, do follow us on all our socials, YouTube, Instagram, Twitter, and you can find links to all of those at the bottom of the Money to the Masses website. So all that I think is left for us to do, Andy, is just to say until next time.
Until next time.